Every day, prices keep rising, but most paychecks do not. For instance, groceries cost more, rent keeps climbing, and everyday essentials seem to get pricier every month, yet salaries barely move. That's the silent danger of inflation. It slowly eats away your purchasing power, leaving you working harder but getting less in return. The truth is, saving alone won't protect you. If your money isn't growing, it's shrinking. That's where investing, especially dividend investing, becomes your greatest weapon for building financial freedom. Imagine earning passive income every month, money that flows into your account while you sleep. That's the power of a smart dividend portfolio. It lets you make money online through real ownership in strong companies. The best part? You don't need thousands to get started. With the right stocks to buy now and a simple strategy, even small, consistent investments can compound into long-term wealth. In this video, we'll explore 3 dividend-paying stocks that can help you beat inflation, grow your wealth, create a personal retirement plan that actually works, and have the potential to surpass your full-time job. I'll show Bobby and you stocks that pay over $2,000 and $7,000 in monthly dividend income, and that are valued at over $1.3 million. In the end, I'll show how Bobby's $30 weekly investment portfolio could grow to an impressive $1,315,950 and generate roughly $55,600 annually in dividend income, translating to about $4,633 per month in passive income. Before we continue, please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. Always conduct your own research or consult a qualified financial professional before making any investment decision. Every investment involves risk. Welcome to Investments Mindset, where wealth builders come to get inspired. Let's dive in. At number 3, we have NetEase, ticker symbol NTES. While it might not be the first company that comes to mind when discussing dividend growth, this tech powerhouse is quickly becoming a favorite among investors who value both capital appreciation and passive income. NetEase has built a dominant presence in the online gaming industry, with globally recognized titles such as Fantasy Westward Journey and Identity V, alongside strategic partnerships with international giants like Blizzard Entertainment. This strong foundation has powered remarkable financial growth. Over the past 5 years, NetEase has maintained an average annual revenue growth rate of 15.66%, with several standout years exceeding that benchmark. On the dividend front, NetEase offers a forward yield of 2.36%, paired with a low payout ratio of 7.22%, giving it plenty of room to expand distributions. Over the past 3 years alone, its dividend has grown by 43.64%, reflecting both financial strength and management's commitment to shareholder value. Historically, the stock has delivered a 5-year return of 68.3% and a 10-year return of 424.10%, signaling powerful long-term potential as China's digital entertainment industry continues to grow. Now, let's put this into perspective with an investment example. Assume Bobby invests $30 per week into NetEase, benefiting from the company's 2.36% dividend yield, a 17.29% 10-year dividend growth rate, and an average annual price appreciation of 16.02%. After 1 year, his investment would total around $1,560. In 5 years, that amount could grow to roughly $11,250, and after 10 years, his portfolio would be worth about $31,680. Maintaining this consistency for 20 years could push the total value to approximately $1,495,112, generating an annual dividend income of around $4,759, or roughly $397 per month when including reinvested dividends. Extend that same strategy to 30 years, and the results become even more impressive. The portfolio could grow to an astonishing $8,612,640, producing an estimated yearly dividend income of $27,424. which equates to about $2,285 per month in passive income. That's the incredible power of consistent investing, dividend reinvestment, and time. At number 2, we have Lowe's Companies, ticker symbol LOW. Lowe's has long been a cornerstone of the home improvement retail industry, offering everything from tools and materials to appliances and home decor. Founded in 1946 and headquartered in Mooresville, North Carolina, Lowe's has grown into one of the largest retailers in the United States, boasting a market capitalization of over $140 billion. Competing directly with Home Depot, the company has established a reputation for strong financial performance, steady growth, and a deep commitment to returning value to shareholders. It has built a legacy of consistent dividend growth and strong capital appreciation, making it an attractive option for long-term investors looking to replace active income with reliable passive cash flow. The company currently offers a dividend yield of 1.79%, alongside an impressive dividend growth rate of 17.99%, reflecting its long-standing commitment to rewarding investors. Over the past 5 years, Lowe's stock has delivered an average annual share price return of 13.78%, driven by steady earnings growth and strong demand in both consumer and professional home improvement markets. With a payout ratio of just 38.07%, the company maintains a healthy balance between rewarding shareholders and reinvesting in business expansion. Now, let's break this down with a realistic investing scenario. Suppose Bobby invests $30 per week into Lowe's, leveraging its combination of capital growth and dividend income. After 5 years, his portfolio would grow to approximately $79,800. In 10 years, that investment would expand to about $33,120, reflecting both reinvested dividends and steady price appreciation. Staying consistent for 20 years, the investment could reach around $1,133,501, producing annual dividend income of roughly $56,364, or about $4,697 per month. But the true power of compounding shines over the long term. After 30 years, that same $30 weekly investment could grow to an impressive $1,133,501 times 1.67, the growth factor. This will provide an approximate portfolio value of $1,893,000, generating annual dividends of roughly $93,900, or $7,775 per month. This kind of long-term growth shows why Lowe's remains a top-tier stock for dividend investors and wealth builders alike. Before we continue, if you find value in this video, even just a little, please subscribe and hit the like button to help us continue to provide more insightful and educational videos. Your support is highly appreciated. Thank you. And finally, at number 1 and topping our list is Morgan Stanley, ticker symbol MS. Founded in 1935, Morgan Stanley has grown into one of the world's most powerful names in investment banking and financial services. With a presence across more than 40 countries, the company manages trillions in client assets and continues to play a vital role in global finance, advising governments, corporations, and individuals alike. Its name is synonymous with financial strength, innovation, and long-term wealth creation. This balance between high-growth investment banking and dependable wealth management makes it a strong long-term choice for investors seeking both stability and growth. Morgan Stanley has also proven itself a reliable dividend stock, rewarding investors with consistent payouts for 27 consecutive years. It currently offers a dividend yield of 2.7%, supported by a dividend growth rate of 16.89% and an average annual share price appreciation of 14.01%. This combination of income and capital growth makes it a compelling option for long-term wealth building. Now let's look at the potential of consistent investing. Suppose Bobby invests $30 per week into Morgan Stanley stock. After 5 years, his portfolio would grow to approximately $4,950. In 10 years, that amount would rise to around $35,300, reflecting the power of dividend reinvestment and share price growth. Staying the course for 20 years, the portfolio could expand to about $223,500, generating an estimated $9,597 in annual dividend income, or roughly $800 per month. But the true power of compounding reveals itself over the long haul. After 30 years, Bobby's $30 weekly investment could grow to an impressive $1,360,600, paying $9,597 in yearly dividends, which breaks down to about $800 per month in passive income. When you combine capital appreciation and reinvested dividends, the total value added to this portfolio reaches over $1.33 million, with the vast majority coming from compound growth. This demonstrates why Morgan Stanley remains one of the most powerful wealth-building investments for patient, consistent investors. Still, it's essential to diversify. Never go all in on a single stock. With that in mind, it's time to build a well-diversified portfolio that combines the strength of these three powerhouse stocks. Together, they create a balanced blend of growth, stability, and dividend income. To calculate the portfolio's performance, we'll take the average of their key metrics. NetEase offers a dividend yield of 2.36%, Lowe's provides 1.79%, and Morgan Stanley pays 2.7%. First, we'll add them up to get 6.85%, then divide by 3 to get an average dividend yield of approximately 2.28%. Using the same approach, we can calculate the averages for dividend growth and share price appreciation across the three stocks. Combined, the portfolio achieves an average dividend growth rate of 14.39% and an average annual share price appreciation of 14.6%, a powerful combination for both income and long-term compounding. Now, let's project how this portfolio performs if Bobby invests $30 per week consistently. After 5 years, the portfolio would grow to approximately $10,920, reflecting steady growth and dividend reinvestment. By year 10, the value would rise to about $35,770, showing the early effects of compounding at work. After 20 years, the portfolio's value would climb to around $223,800, generating substantial momentum from both dividend growth and capital appreciation. But the true transformation happens over the long term. After 30 years, Bobby's $30 weekly investment would reach an impressive $1,315,950. At that point, his portfolio would generate roughly $55,600 in annual dividend income, translating to about $4,633 per month in passive income. When combining capital appreciation and reinvested dividends, the total value added to this portfolio reaches approximately $1.26 million, with the majority coming from long-term stock appreciation and the rest from compounding dividends. This portfolio proves that consistent investing, even with as little as $30 a week, can lead to life-changing results over time. By staying consistent and reinvesting dividends, Bobby isn't just building a portfolio, he's building financial freedom. The key is patience and discipline. If you're serious about building real wealth, then consider this channel your financial gym. Every video is a workout for your portfolio, your mindset, and your money skills. If today's video helped you level up your financial education, even just a little, please smash that like button and subscribe so we can continue to grow and build wealth the smart way. Please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. Always conduct your own research or consult a qualified financial professional before making any investment decision. Every investment involves risk. Click on the next video on your screen. Thank you, my friend.